Hello and welcome. Thanks for joining this guide to UK gold taxes for the 2025-26 tax year. This discussion has been arranged by the experts over at My Tax Accountant, and we're here to help you get to grips with all the rules. If you've got gold or you're thinking about investing, you absolutely need to know this stuff. So let's dive in and make sure you're not handing over more than you need to HMRC. So let me ask you this right from the start. Could your gold profits actually land you with a surprise tax bill? It's a question that catches so many people out. You've done the smart thing, you've invested, you've watched the value go up, but have you thought about the tax man? Honestly, a nasty surprise from HMRC is the last thing anyone wants, so let's get you fully prepared. And to make sure that doesn't happen, here's our game plan for today. We're going to start by looking at what I call the two worlds of gold. Then we'll uncover the tax-free secret. That's the exciting part. After that, we'll walk through exactly how to calculate your gold tax, see how the rules change if you hold gold for your business, touch on inheritance tax, and then we'll wrap it all up with a really simple, handy checklist. Okay, let's get straight into the most important point of this entire discussion. You see, in the eyes of HMRC, not all gold is created equal. Seriously. Understanding which of the two tax categories your gold falls into is the single biggest factor that will determine your final tax bill. Get this right, and you're halfway there. This slide really shows that crucial dividing line perfectly. Over on the left, you've got your tax-free gold. We're talking about UK legal tender coins from the Royal Mint, things like sovereigns and Britannias. The reason they're exempt is actually quite simple. The Treasury can't really tax its own currency. But on the right, it's all taxable. That includes gold bars, foreign coins like the famous Krugerrands, and gold ETFs. Any profit you make from anything in that right-hand column is subject to capital gains tax. And here's a quick did you know for you. There's another huge advantage gold has. While you'll pay a hefty 20% VAT on silver and platinum, investment-grade gold is totally exempt from it. This applies to bars with a purity of at least 99.5% and certain coins. It just makes gold a much more cost-effective investment right from day one. Right. Now for the part that gets every investor really excited. How do you legally generate unlimited profits from gold without paying a single penny in capital gains tax? And let me be clear, this isn't some shady loophole. This is a specific, well-known provision in UK tax law designed for savvy investors like you. So, which specific assets unlock this amazing benefit? Well, we're talking about a very clear list. It includes gold sovereigns minted after 1837, both gold and silver Britannias, and those special series from the Royal Mint that actually have a sterling face value, like the Queen's Beasts or Tudor Beasts series. See the common thread here? They're all official British legal currency. And hey, don't just take my word for it. The power of this exemption is confirmed by the Royal Mint itself. Just look at this quote. There is no upper limit. It doesn't matter if your profit is £5,000 or £5 million. If it's from these specific coins, it remains completely 100% free from capital gains tax. It's a real game changer. Of course, not everyone's portfolio is made up exclusively of tax-free coins. Many people hold taxable gold, like bars or foreign coins. So if that's you, how on earth do you work out what you owe? Well, the good news is it's probably more straightforward than you think. Let's walk through a quick step-by-step guide. First things first, here are the numbers you're going to need for the 2025/26 tax year. The most crucial figure for us right now is the capital gains tax annual allowance. It's sitting at £3,000. Basically, this means you can make up to £3,000 in profit from all your assets in a year, not just gold, before any tax is due. If you go over that, you'll pay tax at either 10% or 20%. Okay, let's run the numbers with a quick example. Let's imagine a freelance designer living in London who decides to sell a gold bar. It's a really common scenario. Here are the 4 simple steps we're going to follow. Step 1 is to figure out the gain. It's the easy bit. She bought the bar for £7,000 and she sold it for £12,000. A little bit of simple maths, and that's a nice, clean profit of £5,000. Step 2, we bring in that magic £3,000 allowance. So we take her £5,000 gain and we immediately knock off the £3,000 tax-free allowance. That leaves just £2,000 that's actually taxable. See how that works? And finally, the tax bill itself. Now let's assume our designer is a higher rate taxpayer. In that case, she'll pay 20% on that remaining £2,000 taxable gain. 20% of £2,000 is £400. And that's it. Simple as that. Now, here's a brilliant pro tip for you. If you've got a larger gain to cash in, say £6,000, whatever you do, don't sell it all at once. A smarter way is to sell half in March, just before the tax year ends, and the other half in April, right after the new one begins. A client of ours, Sarah from Manchester, did exactly this last year. She used her £3,000 allowance twice, back to back, and saved herself hundreds in tax. It's an incredibly effective and simple strategy. So far, everything we've talked about has been for personal investments. But what if you're a jeweler or you trade gold as part of your business? Well, the rules change completely. So stay with me here, because this is where a lot of people go wrong and can end up in hot water with HMRC. For a personal investment, your profit is a capital gain, which gets taxed at those lower 10% or 20% rates. But if that very same gold is considered business stock, the profit suddenly becomes trading income. It just gets added to all your other earnings and is taxed at your regular income tax rate, or corporation tax if you're a limited company, which is often much, much higher. The one upside for a business? Costs like storage and insurance are usually tax-deductible expenses. Okay, let's broaden our view a little bit now and look at some other really crucial scenarios. We're going to talk about inheritance tax, which is vital for planning ahead, and also a few key differences for taxpayers who live outside of England. Here's the most important point you need to know about inheritance tax. Gold is not exempt. I'll say that again, it is not exempt. Its full value is included when your estate is calculated. However, there's a very powerful planning tool you can use. If you gift gold to someone and then you live for at least 7 years afterwards, it's generally removed from your estate for tax purposes. This can potentially save your beneficiaries an absolute fortune. And just a quick but very important note if you happen to be a taxpayer in Scotland or Wales. While the capital gains tax rates themselves are the same across the UK, your different income tax bands can affect the final calculation. So you'll need to use your specific regional bands when you're working out whether your gain falls into the 10% or the 20% tax bracket. It's a small detail, but it can make a difference. Phew, we have covered a lot of ground, haven't we? So, to bring it all together and make it super simple, here is an actionable checklist to make sure you stay on the right side of HMRC after you sell any gold. Okay, here we go. First, always confirm, is your gold CGT exempt? That's step 1. Second, calculate your gain accurately. Third, check if that gain is over the £3,000 annual allowance. Fourth, and this is non-negotiable, keep perfect records of everything. Fifth, report any taxable gains on your self-assessment tax return. And finally, number 6, if things feel complex or you're just not sure, please seek professional advice. And on that very note, if you do need personalized advice for your specific situation, then get in touch with the experts who arranged this whole guide, My Tax Accountants. They can help with gold tax or any other accounting needs you might have. You can reach them by phone on 020-857-8531, or you can drop them an email at info@mytaxaccountant.co.uk. And hey, while you're at it, don't forget to subscribe to their YouTube channel for more helpful guides just like this one. So, we'll leave you with one final question to think about. Now that you know the rules, have a proper look at your own portfolio. Are you really making the most of those tax-free opportunities we talked about? Is your investment structured to be as efficient as it could possibly be? Something to think about. Thanks for tuning in.